Here's a number that should terrify you. $300 trillion. That's how much debt exists in the world right now. Governments, corporations, households all combined. But here's the part that breaks your brain. There is on $300 trillion in actual money circulating in the global economy. Not even close. So how can we owe more money than exists? The answer lies in one seemingly innocent concept: interest, that small percentage charged on loans. It sounds simple, almost boring. But interest is the most powerful control mechanism ever invented. It's the reason nations collapse while never missing a payment. It's why your great-grandchildren will be paying for decisions made before you were born. Today, we're going to trace how interest transformed money from a simple tool of exchange into a system of permanent control. And once you see it, you'll understand why debt never goes away. It's not supposed to. Background: to understand the power of interest, you need to grasp one mathematical reality. Exponential growth in a finite system is impossible. Yet our entire economic system is built on exactly that impossibility. Here's how it works. When banks create loans, they create the principal, the money you borrow. But they don't create the interest. That interest must come from somewhere else in the economy, from other people's loans, other people's labor. Imagine a simple economy with 10 people. A bank creates $1,000 and lends it to you at 10% interest. It comes from someone else failing to repay their loan, or from the bank creating another loan, which just kicks the problem down the road and makes it bigger. This isn't a flaw, it's the design. The system requires perpetual growth, perpetual borrowing, and mathematically guarantees that someone, somewhere, must always be in default. But here's the twist. For most of human history, this wasn't how money worked. Ancient civilizations understood the danger of compound interest. Mesopotamian kings would periodically declare debt jubilees, complete forgiveness of all debts. Why? Because they recognized that interest-bearing debt would eventually concentrate all wealth and land in the hands of creditors, destabilizing society. The Bible prohibited usury, charging interest to fellow community members. Islamic finance still prohibits it. These weren't arbitrary religious rules. They were economic safeguards developed over centuries of observing what happens when interest compounds unchecked. Then something changed. And that change would reshape human civilization. The origins: the modern interest-based system crystallized in Renaissance Italy, in the banking houses of Florence and Venice. Families like the Medici discovered something profound. If you lent money to kings, you didn't just earn interest, you earned influence. Kings needed money for wars. But kings couldn't create money, they needed to borrow it. Once indebted, they became dependent on their creditors. Tax policy, trade agreements, even marriages and military alliances could be influenced by those holding the debt. This was power of a new kind. Not the power of armies or land, but the power of compound interest and dependency. The system evolved over centuries, but the real acceleration came with the creation of central banks. The Bank of England, established in 1694, pioneered the model. Here's what made it revolutionary. The bank was created to loan money to the government. The government got funds to fight France. The bank got interest payments guaranteed by taxpayers. And here's the crucial part. The bank could issue notes based on the government's debt, effectively creating money backed by the promise of future tax revenue. This was alchemy. Private institutions could now create money simply by issuing loans, and governments would enforce repayment through taxation and law. The model spread. Banks across Europe adopted it. By the 19th century, the system was entrenched. Governments would borrow from private banks at interest, and citizens would work to generate the tax revenue to service that debt. Forever. But the true genius of the system revealed itself in the 20th century, when this model went global. The rise after World War II, the interest-based control system became internationalized through institutions. We've already discussed the IMF and World Bank, But let's look specifically at how interest transformed these from aid organizations into control mechanisms. The strategy was elegant. Offer loans to developing nations at low introductory rates. Fund infrastructure projects, often with inflated costs, benefiting Western contractors. Then, when rates adjusted upward or when commodity prices fell, the debts would become unsustainable. Enter the debt crisis of the 1980s. Latin America and Africa found themselves unable to service their debts. The IMF stepped in with rescue packages, new loans to pay old debts. But these came with structural adjustment programs. Here's where interest showed its true power. Countries weren't defaulting because they were lazy or corrupt. They were defaulting because the interest payments exceeded their capacity to pay. The IMF solution? Pose austerity, cut social spending, privatize public assets, devalue currency. This created a feedback loop. Austerity slowed economic growth, making debt-to-GDP ratios worse. Currency devaluation made dollar-denominated debts larger. Countries would comply with every demand, implement every reform, and still the debt would grow. Take a specific example. Jamaica. In 1978, Jamaica borrowed $1 billion from the IMF. Over the next 40 years, they paid back $4.5 billion. Yet by 2018, they still owed $8 billion. They paid back 4.5 times what they borrowed and somehow ended up deeper in debt. How? Interest and compound interest. The amount owed grows faster than the ability to repay. This isn't a Jamaican failure. It's mathematical inevitability built into interest-bearing debt. And here's what makes it a control mechanism. At any point, Jamaica could theoretically default, but that means ejection from the global financial system. No access to credit markets. No ability to import essential goods. Economic isolation. So they keep paying and paying, and implementing whatever policies creditors demand. Not because of colonial armies, but because of the invisible chains of interest. The breaking point: the system nearly broke in 2008, and what happened next revealed everything about how interest creates control. In the years before the crash, interest rates were held artificially low. Cheap money flooded the system. Banks created mortgages loans at an unprecedented rate. Each mortgage was an asset on the bank's books, generating interest income. But remember the mathematical problem? Where does the money to pay all that interest come from? From more loans. From home equity lines of credit. From credit cards. The system required ever-increasing debt to service existing debt. When the bubble burst, the banks faced a crisis. Not just their crisis, a systematic crisis that revealed the fragility of interest-based money creation. Here's what should have happened in a functioning market. Banks that made bad loans should fail. Their assets should be sold off. The system should reset. Here's what actually happened. The banks were rescued with public money. But that's only half the story. The Federal Reserve dropped interest rates to near zero and bought trillions in assets through quantitative easing. This was presented as stimulus, helping the economy. But look at the mechanism. When the Fed buys assets, it creates new money. This new money went to banks and large institutions. They used it to buy assets, stocks, bonds, real estate. Asset prices inflated. The wealth of asset holders exploded. But here's the key. While the banks got zero interest money, regular people and small businesses still paid full interest on their debts. Mortgages, student loans, credit cards, the rates barely budged for most borrowers. This is interest as a control mechanism laid bare. Those with access to money creation pay no interest. Those dependent on borrowing pay full price. The gap between the two groups widens with every cycle. Meanwhile, government debt exploded to fund these rescues. That debt will be serviced through taxation for generations. Essentially, future workers will pay interest on money that was created to rescue banks that gambled with loans they created from nothing. If that sounds insane, it's because it is. But it's also how the system is designed to work. The fallout, the aftermath of 2008, revealed how interest debt shapes not just economics, but society itself. Student loan debt in America has grown from $260 billion in 2004 to $1.7 trillion today. Entire generations are starting their working lives deeply in debt. The interest on these loans compounds often faster than borrowers can pay down principal. This isn't accidental. When you graduate with $100,000 in debt at 6% interest, you'll pay $600 every month just in interest, $7,200 a year before touching the principal. Over 20 years, you might pay $150,000 to discharge that $100,000 debt. That's 20 years where your labor is partially captured by the lender. 20 years where you can't take career risks, can't start businesses, can't buy homes. Your choices are constrained by the need to service interest. Scale this up globally. Poor nations pay approximately $200 billion annually just in interest on foreign debts. That's $200 billion leaving these economies every year, flowing to wealthy nations and international banks. Not building schools or hospitals, just servicing old debts. This is extracted wealth. The resources and labor of these nations are being captured through interest payments on money that was created through accounting entries. And here's the cruelest part. The system is often defended by those it exploits. You borrowed the money, you should pay it back. That sounds reasonable until you understand that the money itself was created from nothing. And the interest makes full repayment mathematically impossible for everyone simultaneously. The failed fix is every financial crisis produces calls for reform. Debt forgiveness, interest caps, better regulation of lending. Some reforms happen at the margins. Student loan payment pauses. Occasional debt relief for the poorest nations. Lower interest rate periods, but the fundamental mechanism never changes, because those with the power to change it benefit from it. After 2008, there was talk of breaking up big banks, limiting leverage, restricting derivatives. Dodd-Frank was passed with great fanfare. A decade later, most of its provisions have been weakened or eliminated. Why? Because the alternative would mean confronting the core issue. Interest-bearing debt, created by private institutions, has become the foundation of our monetary system. Changing that would mean completely restructuring how money works. Some economists propose alternatives. Modern monetary theory suggests governments could create interest-free money directly. Some advocate for Islamic banking principles that replace interest with profit sharing. Cryptocurrency enthusiasts propose decentralized systems without central intermediaries. Each faces enormous resistance. Not because they won't work, but because they would disrupt the existing power structure built on interest-bearing debt. The system persists because it serves those who designed it. Everyone else is told that debt and interest are natural, inevitable, just how economies work. They're not. They're choices. Choices that concentrate wealth and power. Modern parallels -14, 30 to 17 o'clock right now. In 2026, the interest trap is tightening globally in ways that should alarm everyone. Total global debt stands at $307 trillion, more than 3 times global GDP. Debt has grown every year for decades. Interest payments consume an ever larger share of government budgets, corporate revenue, and household income. The United States government now spends over $1 trillion annually just on interest payments, more than on defense, more than on education. That's $1 trillion that could build infrastructure, fund research, or provide health care, instead flowing to bondholders. But here's what makes the current moment different. Interest rates are rising after a decade of near-zero rates. For years, governments and corporations took on massive debts because borrowing was cheap. Now those debts are being refinanced at higher rates. The consequences are already visible. Small businesses that survived on cheap credit are failing. Developing nations are facing debt crises worse than the 1980s. Even developed nations are seeing debt service. Crowds out other spending, and the feedback loop is accelerating. Higher interest rates slow economic growth. Slower growth means less tax revenue. Less revenue means larger deficits. Larger deficits mean more borrowing. More borrowing means more interest. The spiral tightens. Meanwhile, the wealth gap continues expanding. Those with capital earn interest. Those without capital pay interest. Every percentage point of interest rate is a transfer from borrowers to lenders, from workers to owners of capital. The data is stark. Since 1980, the share of national income going to labor has declined in virtually every developed nation. The share going to capital, which includes interest income, has risen. This isn't a coincidence. It's interest performing its function, concentrating wealth over time. Some nations are trying to escape. China has built infrastructure using state-directed lending rather than private debt markets. Some Global South nations are discussing debt repudiation. But these paths are fraught with risk of economic isolation and retaliation. The system has become too big to fail and too destructive to maintain. We're approaching what mathematicians call a singularity, a point where the equations break down. Takeaways 17 o'clock to 1833 essential truths about interest and control. First, interest creates mathematical impossibility. When banks create loan principal, but not the interest, there's always more owed than exists in the system. This ensures perpetual scarcity, perpetual competition, and perpetual debt. Someone must always fail. This isn't a bug, it's how interest-based money works. Second, interest is a claim on future labor. When you borrow at interest, you're not just borrowing money, you're pledging future time, future work, future freedom. Scale this to nations, and entire populations are working to service debts incurred by previous generations. Interest transforms money from a tool into a chain linking present labor to past decisions. Third, interest concentrates wealth automatically. No conspiracy is needed. The mathematics of compound interest ensures that wealth flows from those who borrow to those who lend. Over time, this creates an ownership class and a debtor class. Every economic system based on interest-bearing debt produces this outcome. It's mathematical destiny. Conclusion 1830 to 1930 interest is not a neutral price for borrowing. It's a mechanism that transforms money into a control system. It ensures that growth must be perpetual and debts can never be fully repaid. It captures the labor of borrowers and transfers wealth to lenders. It gives those who control money creation power over those who must borrow it. Most importantly, it makes this power seem natural, inevitable, just the way things are. We're taught that paying interest is responsible, that debt is a personal failing, that the system is fair. But the math tells a different story. The math says that in an interest-based monetary system, there will always be losers by design. The only question is who they'll be. Right now, we're told that debt crisis requires austerity, sacrifice, belt-tightening. But we're never asked why debts that were created from nothing demand real sacrifice to repay. We're never asked who benefits from a system where debt grows faster than the capacity to pay. These questions matter, because the alternative to asking them is accepting that your children and their children will spend their lives servicing debts they did uncreate, transferring their wealth to those who created money from nothing and charged interest on it. If this video changed how you see debt and interest, share it. These mechanisms only work when they're invisible. Hit subscribe for more investigations into the hidden rules shaping our economic reality. And comment, what debts are you carrying? And have you ever calculated how much of your payment is just interest? The system won't change until enough people understand how it works. Let's keep learning together.